Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we've got something special for you.
Yeah, if you are a listener and a follower of Infinite Banking, odds are you're probably not a big fan of 401ks and government plans, right? However, that doesn't mean that your business partners or employees are on the same page. A lot of them are looking for that as a benefit. And to be competitive, we need to offer something for an incentive for our employees to stay and reward them for doing so. And oftentimes, they will do a 401k plan.
They will.
Right. There's a lot of downsides on that, right? But even more so on the employer side, right? There's a lot of burden on the employer. You got to set it up. There's expenses to maintain it. There's employees putting money in, stopping contributions. So there is a lot of burden on the employee, on the employer, but also there's getting tighter government control. Surprise.
Yeah.
Right? But also there's creating some risk where if the plan isn't set up properly, or there's been some plans where some of the assets showed a loss and the employer ended up getting sued, right? So that might sound great, and employers may be looking for it, but there's a lot of downsides to having a 401k plan.
There are a lot of downsides. And a lot of times speaking with small business owners is they feel almost an obligation to be able to provide those types of benefits just to be competitive in the market. And after you talk to them, man, if there was an alternative out there, they would certainly be interested. And so that's what we're going to be introducing you guys today, is something that's a win for the business owner, but also the employee.
Well, I'm excited for this on many levels. For one, I'm hoping to learn that you're going to teach me something here.
Right? Just a typical Tuesday over here. Teach it, Anthony. Teach it, Anthony.
Ironically, today's Thursday, but
they don't know.
You're right. We're dropping on Tuesday.
Yeah.
Well done. I'm familiar with this plan. Like, I've been heard about it, but I haven't implemented it yet with the client. So I'm looking, and I know you're actually working with the client right now. So I'm curious to pick your brain, and hopefully you can teach me something.
Yeah, I'm excited to share. And I love teaching you, having you sit at my feet, just begging for information. Teach me. But number two is most importantly, man, we thought about this for an episode is because this was an idea that I shared with a client just recently. And man, he was kind of taken aback. And he said, man, I wish I would have known about this 5 years ago. And I'm thinking, I wasn't around 5 years ago. I didn't tell enough people, right? So that's what we're doing today is we're getting out there, sharing some of the ideas that we implement with some of our business owner clients. So I'm excited, man. Is the days of somebody working for a business for 30 years and then retiring are over. And so that sentiment is really kind of the idea behind a lot of this is that, man, the marketplace is very, very competitive, right? If you have an employee out there that is very good at their job, typically they're going to be in high demand and people are going to be coming after them. And so this idea really stems out of the fact that, man, employee retention is really one of the fundamental pieces of running a small business. And so that's what we're going to share with you guys today.
Okay, Cam. So I'm going to ask you some questions and you're going to enlighten us.
Okay. Yeah, that sounds great.
So what is this type of plan called?
We call it a cash bonus plan. So there's a bunch of different categories that are out there. There's executive planning, split dollar, there's deferred comp. If you had to put this under a category, it'd be under deferred comp. But internally, we call this a cash bonus plan. And so really the idea behind this is, again, to incentivize an employee or an executive to stick around.
So how does this plan work?
So the plan works is because what you're going to be doing as the employer is you're actually going to be making contributions or setting aside a percentage of your employer's income into an account over a specified number of years. And then what you're going to do is you're going to attach a vesting schedule to that. And so really what you're doing is you're setting aside income for them for the future benefit. And so you're promoting that loyalty and that service over the years. And that vesting schedule is there really to incentivize them to stick around.
So can you maybe expand on what a vesting schedule is and why it's important?
Yeah. So vesting schedule would restrict someone's right to access to those funds. And a vesting schedule is important is because if you put money aside, is you would want to limit the access that they have so that they can't go in there and take it right away. One of the downsides to a 401k plan, a typical plan, is an employer makes a contribution, and if that employee leaves, they can actually take those funds with them, right? And so that retention of ownership or that vesting schedule is a great way for that employer to retain ownership over those funds over a certain amount of time.
Okay, so then when are they able to access, like the employee be able to access?
Yeah. So the vesting schedule, let me be clear on this. The vesting schedule will restrict um, the amount that they can access at certain times or for certain years. But the triggering events of when they would actually be able to take those funds with them would be typically it's going to be retirement or employment service ends. So one of those two things.
What happens if somebody leaves before they're fully vested?
Great question. Before they're fully vested, they would be forfeiting any of those dollars that are sitting in the account. And so that would be retained by the company.
So then the company would keep that.
They would, yeah.
Yep. Now, from the company's point of view, how do one of these plans affect their financial statements?
There's no effect. There's no effect. And maybe let me add this at this point is that I've been intentionally vague with some of the descriptors here that I've used up until this point is that the company is setting aside a percentage of that employee's income or executive's income. Let's say 10% in this example is they're putting it into an account, right? And I've been intentionally vague is you can put it into a savings account and let it sit there. But that's not the best or most efficient place that you can put it. And so really the cash bonus plan is going to take those dollars and then additionally take another step and fund a life insurance policy on them. And when you fund a policies, there's lots of different ways that you can design it. Again, we would be implementing kind of an IBC design with that policy.
So then this will be an asset of the business.
It would be. Yep.
So then I would say this would be a positive aspect to the financials because now it's going to be sitting on the balance sheet.
It would be. Yep.
Right. And so as you know, it's interesting if you do an employer match to their 401k, that doesn't sit on the balance sheet. I mean, that's an expense. So that's going to negatively affect the financials. Where here, this sounds to me like can be an actual positive effect. But then, so now it's sitting on the balance sheet, and kind of a lot of what we're telling people to do is to be able to put their money to work and access it. So who has access to the cash value of this plan?
Great question. The access to the cash value is up to the owner. The owner in this example is going to be the business. And so the employee executive, right, does not have access to those funds. It's a vesting schedule that is triggered. If we're being really specific, there's 6 different events that can trigger access to that. But typically it's going to be retirement or it's going to be employment ending, right?
So could the employer use some of the cash value?
Absolutely. Yeah. Just an asset on the books like they would otherwise. So that is kind of where you would combine the cash value with infinite banking, right? Is they could use that to go acquire more assets, right? More inventory, whatever they wanted to do.
Now, let's say in the rare circumstance that the employee passes away while they're still working, since you're using life insurance, what happens to the death benefit?
So death benefit proceeds, there would be a death benefit that's paid out. In this example that we're talking about, the owner of the policy is still going to be the company. So there would be a death benefit that would be paid to the company. There are, right, we haven't got to this yet, but there are some downsides to doing everything, right? So maybe I'll save that for later. But to make sure that those death benefit proceeds do come to the business, tax-free, is there are some requirements that we must meet.
Okay, so the employer, the business gets the death benefit, and what's the tax rate on that?
0.
Okay, then is there any obligation to pay out to the employee at that time?
There is, right? If you've got kind of a buy sell agreement or a key employee
Mhm.
written contract that says that, hey, listen, right, here's the amount that I would be giving you or your estate at that point.
Cameron, what happens if the employee passes away? Like, let's say they're not fully vested yet, but they pass away. Does employee get any of the death benefit?
They could. The death benefit proceeds would go to the company. And then if there is some sort of buy sell agreement in place with an executive, that death benefit would get passed or used to purchase their percentage of ownership. So in certain situations, it would pass through.
So, Cameron, let's say the employee fulfills the requirement and is retired. What are their options to receive the funds?
The receive the funds is they've actually got a couple different options. One is they could receive a lump sum in whatever the amount that was vested. And then number two is they could receive payments. I think those payments cannot exceed 6. So typically, right, you might write in that contract that they've got 5 payments.
Okay, now what's the tax implication to the employee?
To the employer, it would be a tax deduction. And to the employee, it would be a taxable event.
Okay. Mm-hmm. Okay. So that sounds great for the business owner.
Mm-hmm.
Right. And then let's say we pay them out.
Mm-hmm.
Okay. And again, we're using permanent life insurance.
Yep.
Right. Or sometimes we call it whole life because it's going to last your whole life.
Yeah.
So eventually that employee is going to pass away.
Mm-hmm.
So who gets that death benefit?
Ooh, there is a section in there. There's a requirement of having a company own insurance on an employee.
Mm-hmm.
I believe it's 101J is the IRS tax code. You like that, Costa? But what is actually a notice and consent.
Mm-hmm.
And so that if there's a business that owns life insurance on an employee, is they have to have notice and consent. And so for this instance right there is right, if somebody were to have that, they left employment, they paid them out, and the business would retain ownership of that policy. So and that's got to be written. That notice and consent must be written. It's got to be a written notice to the employee, and then it's also has to be saved on file by the employer.
Okay.
Yeah. I should say at this point, I'm not an attorney.
We need to have a disclaimer in here somewhere.
And
or are you a CPA?
No, I'm not. This cash bonus plan, right, is kind of a melding of a couple strategies and stuff. But right, anything that we do, we're going to run it by an attorney, an accountant, and we're going to make sure that this stuff is in place. So I should say that.
Yeah, this is for informational purposes.
Correct. Yeah.
Right. We're just planting some ideas. There's a lot of details we're leaving out, not intentionally, but we're just trying to open up your eyes to some of these opportunities.
Yeah. Right? And what I would additionally say too is that as I opened with is there's several different executive or business succession planning strategies that are out there. This is one that was a topic of conversation recently. We thought we'd share it with you guys and bring it to some of the business owners' attention. So
Cameron, one thing that we always talk about, there's pros and cons to doing everything, right? Mm-hmm. And we try to be clear, particularly on infinite banking. There's some great things about it, but there's also some not so great things, and we like to share both sides. I'm hearing a lot of great things, a lot of advantages of having this plan, but there's got to be some downsides or some disadvantages. What are some of those?
Yeah, one of there's a couple, right? And like you said, nothing comes without some negatives. One of it would be just plan administration. This is what I would say not a set it and forget it type plan. This is something that's got to be managed and got to be reviewed each year. A couple of those things that I mentioned before, one would be, I think it was section 404, right? Where they 409. I think.
You stop dropping numbers, man.
It's where they talk about the 6 types of separation events. And so that does need to be met, right? So I'm generically saying, hey, retirement or retirement or death, I think is what I said. Mm-hmm. Right. But there are 6 different types of exiting events that could happen to trigger that. So there is some details that we're overlooking here in this podcast. But so that would be one, just plan administration would be number one. Number two, what I would say is that notice and consent piece, right? Is making sure that we've got some of that proper documentation that goes along with it. What's interesting is, or what's important and also interesting is that even if, let's say, you're the owner
Hmm.
and you own a policy on yourself, is you should have written documentation on file stating that you're recognizing that the company has a policy on yourself.
Mm.
So
Okay.
yeah.
Now, if partly kind of what we're comparing this to would be like a matching or like an employee 401k,
Hmm.
right? Now, if I'm a business owner and I could add to their government controlled plan, it's tax deduction to me, right? Now, if we're funding these policies, what's the tax implications of that?
None. There's no effect.
Okay.
Yeah.
I mean, so it's not tax deductible.
Correct. Yeah.
Okay. So that kind of, again, we want to be fair. I mean, that is a difference if we're comparing this to a 401k plan or the matching.
What else I would add there is that if we're looking at differences or advantages, is
Yeah.
that because we're using insurance in this example, is that there is no ERISA oversight.
Mm.
And so as the business owner is you can pick and choose who you extend this offer to. Is with
Mm.
traditional plans is if you open it up to one person is you have to open up to everybody. In this example is you can pick and choose and offer it just to kind of the key employees, the rock stars, right? That, hey, man, this business would not be here without you. And so that's a huge advantage.
You brought up a good point there as well when we're comparing 401ks. Sometimes with these 401ks, if they're too top heavy, where a lot of the high income employees are participating, but not some of the lower incomes,
Mm-hmm.
they they will not allow or put a restriction on some of the contributions on the higher income employees. But like you said here, this isn't a government created plan, so we don't have to follow all of those restrictions. uh, Cameron, as I try to kind of piece this together, what I'm seeing a lot of advantages, and that being we have something that can help our employees
Mm-hmm.
to retain the employees, which is not tied to the stock market, right? We have control on who we put it on and who we don't. Um, there's also cash value that we can use, right? If we're putting money into a 401k, we can't access that.
Mm-hmm.
But this money here, and it's better for the business. It's on the balance sheet as opposed to being run through the income statement. We have a tax-free death benefit, which, as you'd mentioned, could be used kind of if we have a key employee. This also could, I would imagine, Cameron, be incorporated as part of a buy-sell agreement,
Mm-hmm.
which you did mention that. Also, we receive that death benefit tax-free and we pay it to the employees. That's tax deductible. And this made a lot of news. I don't know how long ago, but when Michigan re-signed
Mm-hmm.
their coach, right? Part of the plan was this large life insurance policy, and this is what a lot of these large institutions and companies will do, banks included, right? Where they're funding these policies on their executives and as part of their executive retirement plan, and then they pay them and expense those deductions. And when that executive passes away, the company gets the death benefit.
Mm-hmm.
And so this is something that a company can use, but also this is kind of something I've been telling people, like, this is your business, your family can do the same thing. Where this is not a bonus plan, but I'm just saying, if you're just practicing infinite banking, you put these policies on the executives of the family,
Mm-hmm.
right? And this is part of the retirement plan that we will pay them out. And then then the family gets death benefit again, tax free. And that's how that wealthy, like the Rockefellers, can continue to grow that wealth. And what we're trying to do here is to let the average man, you guys, we can do this, right? But the only obstacle is we got to take some effort,
Mm-hmm.
right? And if this is something for you, want to learn more about, set up a discovery call with us and we can talk about the pros and cons. about this executive plan and or infinite banking. Cam, any last comments you'd like to say?
Nope. Another disclaimer, right? This is all for entertainment purposes only. There's a lot of different strategies that you could look at for executive planning, key employee, buy, sell, all the topics that we discussed. We just touched on one briefly, generically today. If you guys have questions on that, really feel free to reach out to us, like Anthony said. But man, there's some opportunities out there that some of you business owners should know about. And so feel free to reach out. We'd love to review that with you.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.